Now let's have a look at specific components of the balance of payments in a little bit more details. So what exactly current account is? Current account consists not only on trade balance. Very frequently people believe that trade balance will be recorded on a current account, so these balances will be equal to each other. This is not exactly the case, because current account will not only include balance of trade, in other words, the difference between our exports and imports. If you remember, this was one of the components in our aggregate demand. Apart from this, the current account will also record transactions which are related to net income flows and net transfers to and from abroad. For example, let's imagine that you're a British citizen and you travel to France for a gap year and you earn a little bit of money there. And after this, you send this money, you deposit this money into your British bank account. This will represent a net income inflow to our country from abroad. There will be some income coming into the country from abroad. Or let's imagine that you retire, you've earned a lot of money during your working life, and you've purchased a house on the south of France. You spend 1 month there over summer or vacations, but you rent it out for the rest of the year. And you receive income from abroad. You receive rent into your British account. And this income inflow will be recorded as a part of the current account for a British economy. Apart from this, current account will also include net transfers, which can include, for example, transfers to pensioners who live abroad. You retire and live in France, but you are still entitled to receive British pension. And this pension, which will leave the country into your French bank account, will be recorded as a part of net transfers. All of these transactions will be combined under the current account balance. So this is an example of a British balance of payments. One of the components of the balance of payments shows that our current account in a particular year was actually negative. This is what we do. We do run a current account deficit for an extended period of time as a country. So I've mentioned deficits and surpluses for quite a few times already, so let's just ensure that you understand these concepts. Current account or trade deficit is a situation when we import more than we export, if our debits exceed the credits. In other words, we buy more than we sell. We spend money which we haven't earned yet. We are running a deficit, which will need to be covered somehow. If credits exceed the debits, in other words, if we export more than we import, in other words, we sell more than we spend, more than we buy from foreign partners, it will lead to a current account or a trade surplus. So it's often undesirable, as I mentioned already, to run a current account deficit for an extended period of time, even if it's matched by surpluses on two other accounts. It's not really good. It's better to balance it over the long term. If you look at this graph, you will see the extent of this problem in a little bit more detail. So let's have a look at some trends in international trade. This graph shows the current account balance in selected countries. For example, our country is shown here in red. So you can see here that starting from about 1983, we were running current account deficit in every single year. We didn't have a surplus for nearly 40 years. So we've been running a deficit. Some other countries are running deficit too. For example, the country shown in green, which is Australia, and the pink country, which is America, United States. Some other countries, for example, this one shown in purple or in lilac, Netherlands, was running current account surplus for all this period. And Germany too, they are running quite significant current account surpluses of about 8% GDP, while we are in deficit for about 4% GDP. So this is the first observation which you can make. Starting from approximately early 80s, countries somehow chosen their path and they went upwards or downwards. In other words, they are constantly running a surplus or constantly running a deficit. Very few countries are fluctuating around zero. On the other hand, for the first part of this observation period, between 60s and 80s approximately, most countries were balancing their trade. So they were running a surplus in one year, then a deficit in another year, then again a surplus, and so on. So if you look at our red line, so our country, United Kingdom, so you will see that this is exactly what we did. So So a surplus in one year was balanced by deficit in another year, then a surplus again, and so on. But after about 80s, 83, probably countries just chosen their path and were running a persistent deficit or a surplus. So the question is, why exactly is it such a problem? Let's discuss this. On this slide, we see a summary of effects of a current account deficit. So recall, current account deficit is a situation when imports exceed our exports. Let's write it down. Imports are greater than exports. And of course, the first obvious result of this situation would be a leakage from the circular flow diagram. In other words, this leakage would reduce our aggregate demand. If you recall a few exercises which we did in a seminar on national output, you might recall this picture which asked you to label injections and withdrawals or leakages from the circular flow. And it also asked you to list injections and withdrawals. And if you remember, injections were exports. The more we export, the higher the aggregate demand for our products will be, the higher will be the circular flow of income in our economy, while imports are withdrawals or leakages from the circular flow. In other words, if you recall the formula for aggregate demand, the consumption plus investment plus government expenditure plus net exports, which is the difference between exports and imports. When imports are greater than exports, this whole term in brackets will be negative. So in other words, instead of adding something to the aggregate demand, we will remove some amount from it. When it's negative, aggregate demand will drop. So in other words, some amount, some expenditure will be leaving the country rather than adding to the aggregate demand, which will stimulate production, create jobs, etc. Some money are leaving the country to buy imports, so our economy will produce less. This, of course, will lead to lower output, lower number of jobs available, lower employment, higher unemployment, and so on. Apart from this, current account deficit, excess of imports over exports, may cause depreciation in the exchange rate. We'll cover this in a little bit more details at the end of this week, when we'll cover what are the factors which move exchange rates. Basically, when you are buying lots of imports, you will need to pay for them. You will need to pay for these imports by exchanging pounds into foreign currency. In other words, demand for foreign currency will increase. You will want to get rid of pounds and you will want to buy foreign currency. And when there is a strong demand for foreign currency and when people are selling pounds, it will reduce the value of pounds. It will cause a depreciation in the value of pounds. Pound will lose its value because we need lots of foreign currency to pay for our purchases. Apart from this, foreigners will own more domestic assets. This is one of the reasons why it is undesirable to run a current account deficit, in spite of the fact that we are attractive for foreign investors, and we can cover it by attracting foreign investments and running a surplus on the capital account. The reason is, by attracting capital inflows to finance our expenditure, we are basically selling our domestic assets to pay for our consumption level. We want to buy lots of imports and we are selling our own domestic assets. We are selling them to foreigners, and as a result, we sell parts of our economy to foreign residents. We own less of our own country. This can also make our country vulnerable to the capital flight. Capital flight is a situation when investors suddenly decide to leave the country and relocate their capital to some other destinations. Maybe because some other countries offer more attractive investment opportunities. Maybe they can earn higher return on their investments elsewhere. And if we sold lots of our assets to foreigners and this hot money will decide to leave the economy, we will be left with nothing. It can cause a run on a pound, and it can cause a sudden and extensive capital flight, which will undermine financial stability in our economy. Apart from this, the situation when we run a current account or trade deficit, it implies that we have uncompetitive exports. It could be a sign that our economy is uncompetitive. We're simply unable to sell our products to foreigners. They don't want to buy our products. They're uncompetitive. And our own consumers prefer to buy cheaper imports than our own domestic goods because they're more attractive. They are cheaper or better, higher quality, or more attractive or better satisfy our needs. We cannot sell our products to foreigners. They don't want to buy them. And we also don't want to buy our own products. So it's a sign of uncompetitive exports. It's a sign of uncompetitive economy. And on a positive side, however, so all of these factors from 1 to 4, these were the negative effects. The only positive effect of this situation is that it allows us to maintain higher levels of consumption. We buy lots of imports, maybe because we want them, maybe because we don't produce these products domestically, or maybe domestic products are more expensive. So it allows higher domestic consumption than otherwise would be possible than if we didn't purchase these products from abroad. So these are some of the factors, some of the effects of a current account deficit, and these are the explanations why it is undesirable to run a current account or trade deficit for an extended period of time. This slide is slightly more advanced, so don't worry if you don't fully understand it. It contains more advanced information. It's not optional, so this is still part of your syllabus, but don't worry if you don't really understand this yet, because it takes your understanding on a slightly higher level. So let's evaluate the current account deficit. For example, you observe a country which runs a deficit, like our country or America. So is it really bad? Is it something which we should avoid? Why are we running a deficit for so many years, for nearly 4 decades? So what are the factors which we should consider when we evaluate the effects of a current account deficit? So first of all, what is important is that the evaluation depends on how exactly the deficit is financed, by borrowing or by attracting capital flows from abroad. So if we run a deficit which is financed by capital flows, it's slightly better than if we rely on drawing our reserves, for example. It means that our country has slightly uncompetitive exports, but we are attractive for foreign direct investment, which can also increase domestic production capabilities. So we are attracting investment from abroad, which can expand our production potential in the future. It shifts our production possibility frontier to the right. It expands our aggregate supply in the long run, which enables us to produce more products in the future. So it is definitely much more sustainable than a deficit financed by borrowing. So that's the first thing to note. Are we borrow or are we attracting capital inflows? In the UK, we are attractive for foreign direct investment. That is why it's one of the reasons why we can afford to run this deficit for so long. Next, the evaluation of a current account deficit also depends on the causes of this deficit. Is it due to high growth, higher aggregate demand, higher consumption levels, or through uncompetitiveness? Because it can actually occur due to higher growth and strong consumer spending. So our economy is booming, aggregate demand is strong, production is strong, national income is very high, so consumers increase their consumption levels, their spending, and as a result they buy lots of imports. So strictly speaking, it can be a sign of high standards of living rather than incompetitiveness. So we do still have lots of exports, but our standards of living are that high that we can actually afford to spend this money on pleasing ourselves. What is also important is that some countries, like United Kingdom or United States, do run current account deficits, but they also have many foreign assets, so we can afford to maintain it for some longer period of times. On the other hand, some countries like Russia and Venezuela have experienced these situations, these deficits, simply because they were adversely affected by a fall in the price of oil. So their balance of payments heavily depend or heavily relies on oil exports. They're oil exporting countries. And Venezuela, for example, that doesn't really produce anything. And about 90 or 95% of its government revenue comes from exporting oil. And apparently, when price of oil drops, and in the last couple of years, it dropped by about like 70 or 80%, something like this. It was sold originally, the barrel of oil cost up to about $130, and then it dropped to $35. So can you imagine if the price of a good, which is main export for your country, drops that dramatically, literally by a factor of 4. And obviously this damages exports revenue very quickly. So the exports revenue drop, which can lead to a deficit. So this can cause a balance of payments crisis. And of course, developing countries who are relying on major commodities, on exporting major commodities, are much more vulnerable to these factors, to these events, and they're also much more vulnerable to capital flight if international investors decide to relocate. They're scared of changes in regulation, for example, and this can cause significant deficits on balance of payments. And another important factor is in order to decide whether you can maintain current account deficit or not, is whether you can devalue your currency, because currency devaluation could restore competitiveness and improve current account, but it can hurt the economy in the long term. And this is what we will cover at the end of the week when we will discuss effects of exchange rates. So this was a brief summary of possible macroeconomic effects that our international trade can have. As you can see here, there are quite a lot of links between different macroeconomic variables. The exam questions, however, in majority might be rather simple. So let's have a look at this particular exercise. So our country, which we've had already, which has the same record of international transactions, we need to calculate its current account balance. So previously we've had to calculate balance of trade in goods. Now we need to calculate the complete current account balance. So please stop the video, review your lecture notes, come up with an answer, and then come back to check your solution. Ready? So let's have a look at the formula first. We need to calculate the current account balance, and as we've learned already, it will include the balance of trade in goods and services, exports minus imports, plus we will also need to add net income flows and net transfers to and from abroad. So let's do this. In this particular case, in this exercise, we'll need to use all of these numbers. So first of all, let's calculate trade balance. We'll do this separately for goods and for services. So we'll need to take exports and subtract imports. Trade in goods will involve this number. Trade in goods, exports of goods, imports of goods. So 120 and 150, and this is what we have here. Exports minus imports, 120 minus 150. The balance of trade in goods will be minus 30. We are running a deficit in our trade of goods. Now let's have a look at trade in services. So we will be using these numbers. Imports, 60, and exports, 50. As before, we will take exports, 50, and subtract imports, which is 60. The result will be minus 10. And finally, we will need to add the net balance of income flows and transfers to and from abroad. So we will need to add these figures, 80 income flows from abroad and going abroad to abroad, 80 and 30. We receive 80 millions from abroad, and we'll need to subtract 30 millions which we've sent abroad. So the balance will be positive, will be 50 million. And as a result, when we all add up all of these numbers together, we're running a combined deficit in our trade in goods and services, but we receive more money from abroad. So maybe our residents are receiving some income from foreign countries. And as a result, if you add up these numbers together, you will get a total balance, a combined balance of plus 10 million. In other words, you are running a surplus of 10 million. So this is an exam type of question which you might get in your exam in week 13 based on this topic.